I want to welcome everyone who came in today to participate into this webinar. We are getting started now, so the recording will be available later. So first, my name is Kenneth Leada. Many people know me as Carl. I'm the CEO and founder of Day Trading Tanzania. I live in Dar es Salaam, Tanzania. I have 4 years in trading Forex, 2.5 years with Orderflow. And today I'm going to share with you my experiences as an order flow trader, and you can get around to know how to use order flow into your trading. So I hope by the end of this webinar, some of the things that were unclear to most of you guys will be clear now. Okay, so let's get started. Now, before we start and head into order flow, I have prepared a way or manner in which we are going to approach our webinar series. First, trading is all about buying low and selling high. That is the obvious. But before buying and selling, or even before the application of order flow, you need first to formulate your logic. Now, when we talk about logic, those are the reasons for you to buy or sell, let's say, a certain contract, to buy or sell certain instrument in a certain area. It could be based on support and resistance. It could be based on trend lines. Maybe your strategy is to buy, to sell on those lower highs that are being created and buy lower lows. Depends on the strategy, depends on your logic. Then we have chart patterns. We have a lot. We have engulfing patterns. We have head and shoulders. We have ascending triangle, descending triangle. But now, one thing you need to understand that all these things which we call strategies, these are the reasons for us to buy and sell. I'll just give you an example. If you have been using maybe moving average for a certain time, most of traders, we started with moving average. I myself started moving average in my early trading days because I believe it was so easy. It's telling you just if the moving average just crosses over, you buy. If moving average crosses over, you sell. Then later on, you come and find out that that is not the easy thing. There's a lot to be done. But it could be easy because some people are using the same moving average for years and it's very, very successful to them. But why you keep asking yourself these questions, you jump now from strategy to strategy, method to method. Now, this is why we learn order flow. Now, when we are going forward, you realize that all these things need to work together for you to formulate your trade. First thing you're going to have is the logic. What are the reasons for what is making you to think that a trade is going to go up or a trade is going to go down? It could be based on what you're believing. So I haven't mentioned all of them. Let's say you have the BTMM also in here. You have order block, something which we hear nowadays a lot. I've been hearing about it. Well, all those are just the logics. We're just formulating a logic to why you need to buy a certain instrument or why you need to short a certain instrument. Now, what is order flow? So first you have to understand order flow is the study of volumes. What we are studying here, everything in order flow is just related to volumes. Now, the volumes of who? The volumes of these guys in here. And not only these guys, but also the liquidity providers, which the banks will also have the ability to see even big institutions, how they participate into the market. So we have plenty of options when we are learning order flow because we are able to see all those participants, which we learned maybe when we started our career as Forex, we are learning at market participants. But all the way through a journey, it has just been a story. You know that they are there, but you are not actually able to see how they can buy, how they can sell into the market. Now, order flow gives you a view of you to see how the volumes are being transacted in the market. Another thing you need to understand is it is the missing link to many traders. Why do we say it is a missing link? Because most of you guys, you are waking up in the night, drawing your support and resistance regions. You're looking in the past. You're assessing the chart. You're not assessing the volumes. You're not studying any volumes. You're not looking what happened previously in those in volumetric terms. You're just looking at charts. So it's just like a 50-50. And one thing about the charts is they're time based. So for example, let's say an auction is taking place. We have a buyer buying and selling happened in this candle. Let's say this is a bullish candle. But what does it really mean? It means we opened here, then we closed here. Let's say this is a 1 hour candle. Now, okay, we'll get to the questions later. So if you get into a 1 hour chart, there's a lot of transactions that took place here, which you can't really assess. And after the 1 hour closes, that's the candle closes. You don't know, you're just making a judgment based on what this candle did. So for instance, in the next candle now, we get a full bullish bearish candle on the 1 hour chart. Then you come and get an entry here and you're trading technical. So by this time, you're asking yourself now, what really happened? But you can't really tell because first we had a bullish candle, now we're having a bearish candle opened on the high, closing on the low. But there's a lot of activity just happened on these 3 hours here. You came to make a decision here after the close of this candle. Then it goes one candle, two small candles, then reverses. Maybe you got 15 pips or 11, then that's it. So what are you missing there? You're missing the volume, you're missing the real action in there. You're based on candlesticks. Now, order flow highly enhances your strategy or enhances your methodology, which you formulated in the logic. Depends now. If your logic is well and good enough, it's gonna be working 100%, sometimes only minimal losses. If your logic is not well constructed, you'll be losing almost every time, and order flow will be very, very confusing to you because every time you see a buyer, you'll think it's your time to buy, and every time you see a seller, you think it's your time to sell. So you're just gonna have these contradictory thoughts. But the more you formulate your strategies, you can now, when you link up with order flow, it's gonna be easy for you. So which asset class are we mainly looking at with order flow? Now, order flow mainly works with futures, stocks, and cryptos. Why? Because all these markets are centralized. Unlike the FX market, it is not centralized, but we have a 95% correlation with futures, okay? And that correlation is highly based on opening price, closing price, and also the difference which you can notice is only the opening and closing price quotation. Let me just show you that in a moment. Okay. So this one here is an example. Now, this is just a normal candlestick chart. This is a footprint chart. Of course, they are all the same, but this was taken in a Forex chart and this was taken on an order flow chart. Now you can see everything in here, the candlestick formation in relation to this one, everything there is just the same. You'll find out that most of the time, if you go to the chart, you'll find out only the opening price is going to be different, okay? So that is the only difference between futures and Forex in terms of order flow, but the rest is just everything is okay. Now, not only that, another difference is when you're saying, let's say 6E, it's a contract maybe expiring 12 year 2020. So this is how we are going to name them. The opposite of that is Euro USD. Now, you have to understand, this is on future side. We are trading it in terms of contracts. And here, On the FX side, we are trading this in terms of pairs. This is why there's a difference in price quoting. The price on the right, on the FX side and on the future side is going to be a little bit different. So let's keep going, okay? Now, what are footprint charts? Now, we just looked into order flow. We just said it's the study of volumes, but we haven't really looked into the dynamics on how these volumes are they formed, how do they work and stuff like that. So first, footprint shows you aggressive participants. Who are aggressive participants? So the aggressive participants are buyers and sellers coming into the market with instant execution. So let's say me and you, we want to buy 100 contracts or sell 100 contracts. When you place an order, that order we are termed as aggressive participants because we are either hitting the bid or we are hitting the offer. We'll get into that shortly when we are going or when we are advancing through our webinar series. Now here, let's talk about the footprint softwares and platforms. So there are many softwares out there. There is Sierra, there is Trading Station, there's NinjaTrader 7, there's NinjaTrader 8. There's a lot of software nowadays. Some are coming new, some were there since the beginning, like Market Delta. I think that was one of the first softwares on Orderflow. But for us, we are mainly using NT7 and NT8 for our order flow softwares. Now, for order flow on NT7, we mainly use the Ludwig 2 indicator. The reason why I know many people are using also Valtos, we also have Valtos, but we rarely use it because there's a little bit difference in calculation in terms of the volumes that we prefer to see and how the different softwares are generated. You can find this on your own when you are trying to figure out which software is the best to use, and also which platform will suit you most easy for you, either your system or even your ease of use. So for NT7, I'll just show you my NT7. This is NinjaTrader 7. And for my indicator, this is the Ludwig on my Ludwig on NT7. So you can just see here, it shows us bid by ask footprint. Now, we'll get into that, all the details. So I would also to show you before we are going forward. Now, we just talked about footprint charts. What are footprint charts and how are they really formed? Now, footprint charts are a little bit different from other charts. We call them footprint because they give you the roadmap of what happened behind the candlestick. Now, within the candlestick, we know that there are transactions which took place, and we have two sides of them. We have transactions which take place on the left, and we have transactions which took place on the right. So excuse my drawing. I know it's a terrible drawing. Let me try to redraw that. So we have the bid. We have the bid side, and we have the ask or offer side. Now, while we are assessing the footprint, it means we are looking at those participants in the left, we are looking at those sellers that sold into the bid. And on the ask, we're looking for those buyers that bought into the offer. Now, this is, when you're talking about bid and offer, it could be a very, very confusing concept, but it's very, very easy. Now, just on your MT4, if you're looking at it on a normal day, you find that we have the bid price and ask price. We have two lines in there. Now, if you want to be a buyer, your order, when you place your instant execution order, it's going to be opened up on this line here. Why? Because you bought what has been offered for sale in the market. And if you are selling, your order will be opened in the bottom line, because you are willing to sell into into the price that is being bid in the market. So these guys are willing to sell to, they're willing to buy from you who is selling, and these guys are willing to offer for sale for you who you want to buy. So you will understand that the market is more of supply and demand if you're looking at this concept alone. So that is how the market is, and that is always how it's going to be. It's always about supply and demand. Someone is buying, someone is selling. If you're buying, someone is selling to you, and if you're selling, someone will be buying from you. Now, how are these charts formed now? We know we talked about the footprint charts, but how are they formed? First of all, this is the footprint chart here. Okay, this one here is a footprint chart. So all this together, we call them a footprint chart, but a one candlestick, we call it a footprint bar. So let's say we are talking now about this particular bar here. And on the left, you can see that this is showing you that this is a bullish candlestick or a bullish footprint bar. Now, this shows us the transactions which took place in that bar, also shows us the sellers on the left, and also shows us the buyers on the right. So this is just for you to know what a footprint bar is. Each number in here is the transaction of those buyers and sellers who are bought in real time. Now, you'll notice that some areas they put X. So the X is not any multiplication factor or anything like that. It's just a separator or a spacer. You can see here bid, ask, ladder. So it's just to separate, but there's no any mathematical calculation involved in it. Now, we need to understand at least how this bar is formed. So let me just show you in a moment here. First, we have the transaction will take place here. Okay, so let's look at this video here. Now, for every buying and selling transaction that takes place on the bid or ask that I showed you, so we have the bid, we have the offer, and we have the bid here. For every transaction that is taken here, either it is one lot, even if it is 50 lot, all these transactions will be recorded in the time and sales window. So when they're recorded here now, we can't really get an actual reading here. So this is some people were using tape reading back in the days, but you had to be so fast to execute. Even today, they're still using tape reading method, but you have to be, sometimes you have to be a little bit fast to execute and see how the market is moving. Because once this goes down, you can't bring it back up. It goes, it goes. You only be able to realize that we are having a certain amount of trades that took place in a certain level. So now the time and sales is a window, is like an online receipt. You go to the supermarket, you buy some tomatoes, they give you a receipt, and the receipt shows you that you bought tomatoes and how much did you buy and in what quantity you actually bought. So this is what the time and sales is. So this is the receipt. It tells you the time, what price, and the volume or amount which you bought. Now this information is then taken into the footprint chart. Now the footprint chart takes into account price, we have time here, and we have the volume, the total volume. Now this is taking the total volumes that have been traded at each particular price point and groups them either on the bid side or on the offer side. So let's play this and see what do I mean. So you can see here, these transactions that are coming in here. So let's say, okay, new candle comes in. Look, we have 8, we have 10, and we have 10 lots have been traded there just after the new candle. Look at 2 and 8 at this price point, or 26.51. These orders have just been placed here that they have sold into the bid at this particular price point. The previous one was on the upper price point, so it happened on the previous candlestick. So let's play that. So you see more, we added 5 lots, and we just see it went to 15. So not to spend a lot of time here, but I hope that is clear up to there on how we form our footprint charts. We know that the information first starts from those buyers and sellers coming into the market. We are going to see later on what makes them buying and selling, what could possibly, because every buyer and seller or every guy out there can come into the market and buy based on their own type of logic. So we can't really tell what logic is behind. But while we are assessing the volumes, we can think on what the market appetite is and how the market would want to transact. So we will go into that as we are going to continue, okay? So let's take this away and let's continue. Now, what is the best time frame for footprints? We need to at least understand which is the best time frame for you to properly analyze before we now start to look into what types of things would you like most likely be analyzing while you're looking into footprints. So the best, we have two ways to be looking at this. You can either use a minute chart or you can use a range chart. I know some people who are using point and figure chart, and some others, I think someone was trying to, some I know who was using a Renko chart. Okay, now each one has its own advantages based on what you want to see or what you're comfortable to analyze for you on yourself. Now, for the mini chart, as I spoke earlier, a mini chart is mainly timely based. So it will show you a new candle has started, even if we are in the same area we are trading. So a new candle will print even though there is no much trading activity has occurred. But as traders, will be forced to think that price is now trying to create a new auction in the market, but that is not something which is true most of the times. Now, for a range chart, the range chart is taking into account the range of prices that will be surpassed or will be skipped by prices, will be covered by prices, or the prices that will be traded. So let's say we're having an X and Y axis here. So this is our Y, this is our X. Now, we have a list of prices here. Now we can choose this to be anything. We can choose this to be a 4 range. After price area to price area, it could be 4 range. So let's say 4, 8, 10, 12. But you can just see, okay, this is 14. So 12, 16. So we are seeing that after every range, another candlestick will open. So after every 4 ranges, another candlestick will open. But let's say it was a time base, it means price will just be going up and down without showing us the distribution of price and with volume. Now the range chart just gives us a distribution of price against the volumes traded. So it gives us an easy way for us to analyze on the quick changes of supply and demand or the quick shifts of supply and demand. So for example, we are coming down, let's say we are going down, then price is going down, then eventually just shifts. We see multiple bars are printing, maybe 1, 2, 3 bars have already printed. Now on the mini chart, if it will be an impulsive move, it will just go down like this, then come back up, then leave you with a wick. You might not take a decision until you see that candle is closed. While by then you're making a decision, the ship has already sailed. So we don't want to get into scenarios where the ship has already sailed. So another one we talked about point and figure. Now for point and figure, most of people using point and figure are those who are looking for rotations, market rotations, where the market accumulated, then broke off from the accumulation, then rotated again, then broke off. So I've never used point and figure, so there's not really a lot for me to talk about in point and figure. So I'm a user of the range charts, and I like the range charts because it enables me to see the shifts in supply and demand easily and quickly. Okay. Now let's talk about footprint analysis. So in footprints, when we're analyzing the footprints, when we want to read the footprints, we have three ways of looking into them. First, we can look at Intra Bar Analysis. Intra Bar Analysis will be focusing on patterns which are forming when the bar is forming. As the bar is forming, the bar hasn't closed yet. These are those type of patterns which you want to see. So for example, I can just show you here. So when we say intrabar, it means we are looking at this bar while it is forming here before it closes. So we'll try to read it, look at it, try to understand how price is trading with them as that bar is forming. So there are a couple of patterns which you could be looking as the market is moving. So we know, first thing we know, we'll be looking at imbalances. Now imbalance, in a short way or in a simple way, we could call that is the difference between buyers and sellers, who is stronger than the other. We want to know, or we want to understand between the buyers and sellers who are stronger. Before we proceed on that, I would like to talk about one concept, the delta, because delta is what shows us imbalances. Now, delta is when you take aggressive buyers minus aggressive sellers to get the total of who is in control. Now, delta will give us the measure easily on what is moving price either up or down, although that is only when other factors are remaining constant. So there are other more factors which can't remain constant, which we'll look into slowly as we are advancing. But first, we need to understand delta. Now, imbalances, there's two types of imbalances. We have imbalance within a candlestick, okay, now, or within a footprint bar. So let's say here we have 10, we have 11, 12, 13, okay, then here 16. So when we talk about imbalances within the candlestick, we are comparing imbalances diagonally from this price point here to this price point, okay? And the reason for that is because when you look at the DOM, so let's say this one here is the DOM. We have bids and we have offers. We'll talk about the DOM when we get into the last part, but I can just introduce the DOM to you now. Now, the DOM is mostly referred as the depth of the market. The depth of the market shows us all passive participants. And when we talk about passive participants, we are talking about buyers and sellers with limit orders. Those participants who want to get into the market at their respective prices or at their respective levels. Now, we might have this in the DOM. Normally, we have a number of instruments or a number of contracts that are sitting there. So here we have offers. So these guys are willing to sell at these price points, and these guys are willing to buy. So they are willing to buy. They are bidding. Now, every time when price is going down or up, it means we are either trading, we either lifted the bid to go down, or we are lifting the offer to go up. Now, when we say lifting, it means we have more aggressive buyers who bought into the offer and accepted to trade here and keep going up. So if the market is dominated by buyers, it means they will be lifting the offer and pushing the market to go up. So they are buying the offer and they are pushing the prices to go up. And if we are selling the offer, it means they will be selling here and the prices will be moving down. Now, let me just give you an example of this. Why we are saying this, it originated from the footprints, because these transactions here, we cannot go down until we have taken away this offer or this bid here. And we cannot go up unless we have taken this offer here. So every time from the DOM, the buyers and sellers are compared diagonal. You are going to look at what is being traded now and what do we expect to be trading. So this notion now, we come with it even to the footprint. When we are looking at imbalances, we are comparing from the left going to the right. Now you'll find out that you cannot change. Let me take away this first. You'll find out that you cannot have only one pattern of imbalance to take you either to make sure that the market is going up or going down. Now that is with balance within the candlestick. But in total, when we're looking about imbalances, we are looking at the delta. Now we are looking at the number of bars, prices moving down. Then we are looking at the delta here to tell us how much is being traded and are we seeing that there is going to be a continuation to go down or start something like that. Okay, now that is for imbalances. So another thing you could be assessing as the bar is forming is the drastic color changes depending with the type of software you're using. Okay, now for example, I just showed you mine. Let me just show it to you again. So this is, okay, let me give you another video here. Okay, so you can see within this video that as price is moving within the bar, you'll notice that there is some color change that is going through. Now, color change is easy to read and very, very easy for me to interpret as the bar is forming, because with the color, I can just say that the buyers are becoming stronger or the sellers are becoming stronger. Or if someone is becoming weaker than the other, it's easy for me to know and tell, rather than when I cannot have these colors. Now you can see, for example, here, we are seeing that when the market is coming down, we had a lot of reds, but then we are seeing now some greens is starting to come in. So this tells that, or this alerts us that although price is going down, but now we are starting to see different ideas from the participants that are present in the market. Okay. So this is just for you to see the colors and shades of these cells when price is moving. So we'll keep going. So another pattern, another thing that we will assess in our analysis while you're analyzing the footprints is look at the absolute values within that candlestick. Now, let's say we already, okay, first, end of bar patterns, these are patterns which are forming after the candlestick has formed. So when we're talking about that, we are talking about, now we have this bar that is forming here, but we have a bar which has already finished forming previously. Now from this bar, what interpretation can we get? So we are looking at the following things. First, we are looking at absolute values that has been traded in this candle. Now, when we say absolute values, it means we are measuring the volumes. How much has been traded? We look at the delta. How much has been traded within the candlestick? What is the distribution of volume? How has it been distribution? Do we have an area of high volume nodes? Do we have an area of low volume nodes? Because this is the study of volume, so we need to take everything into account. So when we say high volume node, we are talking about the area in which experienced most of the traded volume in the previous candle. So for example, in this candle here, you can just see here that we are seeing that there is high volume activity in here to sell because it is dominated by red. Even here, we see that there's more red activity and there's more selling activity, although we have a high volume node, although it is not high. Now, let me just explain this to you for those who don't understand, okay? When you talk about nodes, you're looking at this within the footprint. It's showing you that we are having some sort of a volumetric distribution in here. It's like a volume profile, although it's not a complete volume profile, but we can see that it's a volume profile, okay? So that is what we can be assessing. Another thing we need to be assessing after the end of the bar has formed is we will see that we have uncleared auction or unfinished businesses. Now, what do uncleared auction mean? When a bar has closed, we need to make sure that we have zero on this side and zero on that side. So whenever we don't see a zero on both sides, it means that auction is incomplete. So let's say here it's 11, here it's 12. So in the future, we expect the market to come and trade through and clear this auction. Now, for example, look at this one here. Price made a fall, then made a flag. When this flag created an uncleared auction. Now, this candle here comes and closes on the low. And when it closes with the zero. So this candle came in here, retested the level, and look at the volume activity where exactly it happened on the previous area. And now when we close with the zero, it means we have already completed this auction. We have cleared this auction. Now the business is finished. There's no reason for us to come and retest this or reverse that area anymore. So that is for uncleared auction. So lastly, on analysis, the pattern that we'll be looking is multi-bar setups. Now, multi-bar, you'll be looking at all those patterns which are forming when we have multiple bars in there. For example, we could be looking at absorption. We could be looking also at exhaustion. Now, tricky thing is when you are looking at multiple bars, you'll be asking yourself maybe, how many bars do you actually need to look? But you need to understand how did you formulate your logic in from before. So the logic will tell you how many bars you'll be looking. For example, let's say price is at your area of interest. Let's say you have a support or resistance region. Then you are looking at price, exactly what is price doing at this area. So it could take a while. It could take 1 hour. It could take 30 minutes. So you need to look at all those bars and understand how that volume activity there has been traded. So let me just show you an example of absorption. Now, when we say absorption is when we have excessive buying or we have excessive selling, but price is not going anywhere. Now, let me just show you an example here. You can just look at this particular bar in here. Now, the market made a short, and now price is retreating up slowly. Now, look, when you look since when the market was reversing is more positive delta, we have more buyers coming in there. Then in this candle here, what happened? We have more buyers still, but price here just failed to continue to go to the upside. And even if we'll try to look at the sellers, they're not really plenty. They're not really too aggressive to push the market down. But these guys, they bought and they failed to go up completely. But not only that, we can also see that there was exhaustion within this candle. First, they were absorbed, that all this buying power could not push through, even from the previous candlestick, because from here to here, that's a tremendous, it's a tremendous amount of volume, but it's a very, very small movement. Only few pips. You can see they were just within this candlestick. They extended here for some pips, then they couldn't go to the upside. Then later on, price retreats to the downside. Now, there's two things we are seeing there. We are seeing there's absorption. First, all these bars, where did they go? All their effort went to waste. Another thing, we are seeing that there is exhaustion. On these last volumes that prices traded, we see that there is a sequential decline in prices. You see that we have 33, 9, and follow. So when we say sequential decline, it means price is declining in a sequential mode. We are coming from 3 to 2 to 1. Now, all these are patterns which you are assessing while a footprint bar is forming or while a footprint chart is going on. So we have 3 to 1. Look at this, we have 33, 9, and 4. It's telling you that the buying side is failing to go up. Not only that, previously we saw that there was a big area where there were buys, but they were not able to push prices to go up, and hence they were absorbed. Okay? Now let's proceed. So up to there, we have already looked at how you can analyze, how you can look at footprints for you or for yourself. Now, before we talk about how to trade with footprints, I have just created or formulated one logic that I can share with you guys for you to see. So let's look at that, okay? Where is it? Okay, I think it's not here, but this is what I wanted to share with you. We said here that order flow is the study of volumes. Now, when we study volumes, we have our key areas, or what we have our key things that we're supposed to be looking at. So when you're talking about volumes, now let me just share a whiteboard here. When we talk about volumes, it means we are looking mainly at the distribution of price. How did price trade, and how do we expect it to be auctioned? Okay. Now, for example, the market is trading all the day, maybe from when the day started, going down, then we went up, and later on we went up, then we rejected, then the day ends there. We can say this was an uptrend, then later on it became a downtrend, but this is just structure. We can see exactly how the volume is traded. Now, on the volumetric, volume profile, we will see that the distribution of volume. So let's say we call this bell-shaped. So we know we have here an area where there was high volumes. Then the market traded, we have more volumes here. Then we have low volumes here. So on the market profile, or on the volume profile, we have a distribution of volumes traded at each particular price. Now, there's a concept going on that, you know, okay, I don't want to say, I really don't want to say it's a concept, but many traders now know how to trade with the volume profile, but they're mainly looking at the areas of high volume activity. But does it mean only that is the only thing that you should be looking at where we have the high volume activity? Well, it depends with your logic now. This is why I said I cannot really say it's a bad thing to look at that. But the volume profile has a lot of things that you should be looking or you should be assessing. For example, we know we have three structures to the volume profile. We have the P-shaped, we have the B-shaped profile, and we have the normal distribution profile. Now for each one here, we know this one here, we had a period of buying, then later on we came in an area where we just started accumulating into the market. So we met responsive sellers there, or we met passive participants that are not willing to let prices to go up unless we get more aggressive activity to pass through. But if you're coming into a new day and the previous day we see a P-shaped, this is what it will mean. We know that we had buyers, then they came here. This is where we did not go through. We ended the day there. It depends now. When we say the day ended there, we have to be at least a little bit very careful, because where the day closed will tell us how strong is the market. Is the market strong bullish? Is the market strong bearish? Is the market balanced? All these factors depend on one another. Okay. Now, another one is for the B-shaped. We know that we had a period of selling. Then let's say the day ended somewhere here. Now, for all this, we're going to say the day ended within this range here, and the day ended within this range. So what it will mean is all this buying, all this selling here, they came to take their profits here, and they are now accepting these areas here. The same applies to these guys here. They bought, they came here, they're now accepting value. They took their profits there. What about these guys? These guys, they just want to sell the high. They are rejecting the highs. Then they're also rejecting the lows. They just want to trade in between. They're just comfortable there. Why? They have already obtained fair value. So we have trending characteristics in there, and we also have accumulative characteristics in there. But let's see how we can use the profile. Now, the profile will tell us the distribution of volume. How? First, let's understand the characteristics of the profile. We have high volume node, so let's call them HVNs, and then we have low volume nodes. Now, high volume nodes, it means we had high volume activity on that area, and low volume nodes, we had low volume activity on that particular area that we are traded. But while this auction is going on, so this is an auction, this auction is going on, there are many things that could happen in there. We could have some faults, maybe some prices we didn't trade that well, so we could call them gaps. It's also a study in volume, we need to understand it. Not only that, we need to understand about control. Who is in control? Just by looking at the profile, we can tell who is in control. Also, we need to understand about value. Now, this is tricky because we could say value is just high volume node. But value is any place where traders were comfortable to trade for some time, then broke away from it and went to the upside. Okay? So we have multiple issues to be looking at here. So the high volume nodes, this is a strategy known to many that when the market revisits the high volume node, it's going to be either supported or supported to go down, or it's going to be broken, retested, but it means that this area here is an area of interest. Okay, that is for the people who are using high volume nodes. Now for low volume nodes, it depends where did it happen in the market. Did it happen within the value area or did it happen on the low? So if it happened on the value area low, it doesn't really matter because we expect low volumes to be traded down there. But if we see a low volume node within the value area, we know that is a problem. And we know that the market will come and correct because this is an auction taking place during the day. So whatever anomaly that will be created is going to be corrected before the market moves on to the next stage. What about gaps? When we have gaps within the profile, we know that these gaps are also going to be traded through. Then lastly, control. Now for control, it means that we are looking at where did the market close and how do we expect in the new day what we are going to see. Now, let me just give you an example of this. You can get the market open. Let's say we have this is the profile. Then later on, in the next day, let's say this day we close above here. Now, understand one thing here. If we close around here, we already know that this is the value area. Okay, this is where most traders were comfortable to be trading. Then we just closed above the value area. The traders were comfortable to trade here, but the market closed above. These guys are really in control. The buyers who took prices here, the prices came from down to go to up. The buyers were in control. Then don't be dismayed when the next day comes, when you open it the next day, then you get a profile like this, then the market continues to go up. Why? They already gave you an answer from the previous day. So this day here, they gave you an answer. What are we going to do in the next day? The control had already shifted. We accumulated, let's say, almost all the day. We were just going up, rejecting, going down, going up, trading up, down. Then later on, we just close around here. In the following day, when we break this and go up, you're looking at, oh, my trend line, it was being respected, now it has just got broken. But you're not understanding the key thing in here, the distribution of volume. This was the most traded area, and we closed above it, and price will likely go on to continue to go to the upside. Now, there are a lot of strategies I could tell you about the volume profile. There are a lot of strategies, sincerely, but Let's just go with this one and let's try and look our validity on it on the footprint side. How can we be trading it? Because after breaking it, after breakout, we know we are looking for strength and weaknesses. Who is strong? Who is able to push prices to go to the upside? This happens every day. The breakouts, the retests, the continuation, they happen every day. But it's just people are looking for new strategies to apply them. But the issue is it's just volume is what is missing to many of traders out there. Okay. So now let's continue with our footprint, then let's finish up on it. Okay. Now, if you're trading with footprints now, remember we said footprints is the missing ingredient to many traders. Now, if you're trading with footprints, it means first you need to have predetermined entries and exits. Now, we just talked about the profile right now. So if we're talking about the profile, let's say we are looking at the previous profile, we just opened, with our example, we opened here. Then what are our predetermined entries and exits in the new day? So we opened around here. We know that, let's say this was the value area high, value area low, and this one here is the value area. So we open above the value area, and the day in the previous day is just telling us that price will likely go to the upside. So what are we looking at here? Now, we need to have predetermined entries and exits. From this structure, you will formulate what are going to be your targets and what are you going to be doing into that market in that day. For example, here we know that first you have the following. First, you have the mean of the previous day. That is your POC. That is already your area of interest. We are trading above it. So this is your area where you expect a retest in price and go up. Or this is an area where you expect for you to take profits when you're coming down. Now you have two places to take profits. You can take either here or you can take your profits on this value area line area. Why? Because in the previous day, they showed us that they rejected this area, they rejected these prices. And if you go to the footprints now, that is when we are going to assess down there. What did we see? Did we see multi-bar? When they're looking at multi-bar patterns, we're looking at absorption. Was there any absorption down here? Was there any exhaustion? Now, every pattern that you see will have its meaning where it happened. Don't be a fool to only focus on imbalances. Imbalances are just like comparing who is stronger. But what about those participants who are hiding their orders, who are absorbing the liquidity? You know, how about those? So don't only depend on imbalances. They will make you trapped, my friend. But with this now, you are looking on the previous day, what really happened on these lows? Did we have exhaustion? Or were sellers exhausted? Were buyers exhausted there? You know. Now on the new day, which we are coming, after making this assessment on what happened here, now on this new day, what things are you looking at? First, you are looking at what you're expecting. You already say maybe you're expecting for price to go up based on the control. Where did they close? But in the new day now, you are looking at price. What is it doing in the footprint chart? How are the volumes being traded in the new day? We just closed above here. Are we seeing more buyers in this region? Are we seeing more buyers trying to push prices up? That is the big question you should be asking yourself. So whatever you'll be looking about there, it should be either, I don't want you to be biased, like you should be looking for buyers and only buyers and buyers. No. Look for buyers, both buyers and sellers. But just know that this is the territory that buyers are mostly dominant or mostly stronger on those regions and have the ability to take prices low, to take prices higher, sorry. Now, there might be happening scenarios where we could be experiencing some algo activity. It happens. And when you're a trader on order flow, you will see them almost every time. Sometimes you'll even see them, you might even get sad. I don't want to say sad, you might even get mad based on what they are doing in the market, because you know what they're doing. They're just trapping liquidity here, they're trapping more traders here, then they're going to the other side. And it happens every day, especially depending on the market conditions and the ongoing issues. So when you're here, you should be looking for buyers. But what if you're here, then you see big sellers coming into the market? So what means is the auction has now changed. Okay, so let me just clear that. Let me delete some of it. It's starting to become dirty now. So it means that the auction has changed. That those buyers were previously present on the previous day, they don't want it anymore. Maybe they were just doing that to make you believe that they want to go up. Then in the new day, this is what matters. Forget, you already know what happened the past day, you already analyzed, you're already expecting something. But the new day will tell you what to do. So from these highs now, based on the footprint, now trading with the footprint, you already have your predetermined entries and exits. You want to get in either to buy at these levels. Now in the new day, there are new levels also going to be created based on the profile. Now this is, I'm not saying that you should highly rely on the profile, because remember, we only chose this logic because this is what we can explain it for now. So we already have previous days information, but the new day's information now, new levels will also be formed. How? We have, let's say, a D-shaped profile on the new day. We're seeing value area low, value area high. Now we are looking at price. This is the distribution for the new day. And the new day, remember, we have sessions also. We have Asian session. We have Frankfurt. We have London. And we have New York, depending on what time frame or what session you're trading. I trade London session, so when I come from London, I want to see what happened Asia, what happened Frankfurt. This is just 1 hour to London. What happened 1 hour before London opened? Was there any big buyers trying to move price? Were there any big sellers? Why? Because sometimes these guys, I believe these guys will wake up early just to place in their positions during Frankfurt, then move the market later on. So in the new day now, just look at how the market is auctioning when we come to the lows, and also how does it auction when we are on these highs. Okay, so we could be rejecting prices up there, coming down. Now this is coming from this profile area here. This is a new day, we're just breaking it down. So while we're breaking it down now, we are looking within this area and also combining it with our footprints. Are we seeing buying imbalances? Are we seeing aggressive action? More buyers coming into the market? Are we seeing prices intending to push prices more to the upside? So this is what we'll be looking more into the footprints. And then without forgetting, what patterns do we see within, after every candle close, after every transaction is taking place? We want to understand what is going on. What is going on? If you're going up, then later on we start going down. We want to understand what is happening in the market. Okay? Now, a key thing to note, I know I've talked a lot on this area, but the reason I'm talking a lot because when it comes to strategies, it takes time to formulate, and also not only time, you need to test your strategy from time to time, test it on different market situations when the market is too volatile or the market is less volatile, and see how can it perfect. Okay, there's no a perfect strategy, but at least you have those 90%, 92, 95, some get 98, you know, it's just based on you and how much you tested it, how much time did you give to it. But the key thing always to note now, in even all of these included now, these are the key things to note. First, always you have to assess at the intensity of volume traded, the number of buyers and sellers that came into the market to move prices, either going up or going down. Then the second thing, you'll be looking at the level of imbalances. Now, the easy way out to be looking at level of imbalances is you are looking at across number of candles, and that is based on the delta. So this is how you'll be looking at it. You'll be looking at delta information. But now, what about when you see there is negative delta and then the market is not moving? What does it mean? Now, that is when you now need to break down your analysis, and now you need to understand about intra-bar, end of bar, and multi-bar. You need to practice on how you can spot these different patterns so that when you see delta is negative and price is not moving, you'll understand that we are being absorbed. Okay. So that is for footprinters. Let's now head to the final part on how we can see the heat map and how to, what is the heat map really? Okay. Now, when we talk about the heat map, we are mainly talking about liquidity. Now, what is liquidity? So liquidity is, many people term it as something near money. That is just the general definition. But liquidity is the ability of an asset to trade at a certain price point without affecting any changes in price. Now, for us in trading, liquidity is the passive participants, the buyers and sellers that are present in the market, those limit orders. So we have the limit buy orders and limit sell orders. Okay, all these guys are providers of liquidity. How do they trade? They trade by placing their orders and waiting for price to come into those orders and fill them. Now, remember when we just talked about the DOM. So this is where we can see where liquidity is. So sorry, excuse my drawing there. That's really ugly. Okay, let's put in another one. So this is better. So we have this one here. So let's put it like this. So you can see here, there's a, let's say this is our price and whatever. Okay, this is our price area. We have the bids on the left. We have the offers on the right here. So we have liquid buyers and sellers, different contracts waiting to be filled into the market. Now, a small mechanism is, let's say this price point 1, 2, 3, 4. These guys are waiting at these price points for them to be filled into the market. They don't want to be involved in the current prices, but they want to be involved when they feel like to be involved. Now, these guys, they're actually contributing to liquidity. Remember, this is the market. The market has to have buyers and sellers. And not only buyers and sellers, we have to have willing buyers and sellers, because this is what creates demand, the willingness and ability to buy, or the willingness and ability to sell. You're not forced to buy, you're not forced to sell. So we have buyers and sellers placing their positions. So what are these guys doing? It's like, guys, I'm selling my phone for $100. Then your friends will say, oh, okay. Someone is just saying, oh, okay. Oh, okay. Then eventually someone will just come in and buy your phone from you. So you are a willing seller, you are bidding your price. Then there will come a willing buyer who will want to buy at that current market price that you're giving. So about liquidity is just about waiting for price to come to your level and price to trigger your order and go to the other side. So what is the difference between liquidity and volume? So volume is after the transaction has taken place, we can assess the volume. We cannot look at the volume while we don't have any transaction that has taken place. But liquidity is the probability for trade to take place. So a trade could take place or could not take place. And why is that? Because the order could be closed by participants or it could still stay even in the market depending on the participant themselves. Okay, so that is just liquidity versus volume. Now, when we talk about bid-ask volume, it means we are recording the total number of sellers, the total number who got interested with the bid volumes. So those are the bids. We are calling them the sellers when we are looking at them in the volumes. And the ask, that is for the buyers. We are assessing how many buyers actually bought. We are measuring what they did. Then for liquidity, the bid, these are the passive participants. They want to be filled at certain price point. So the bids here are the buyers in terms of liquidity. And the offers here are the sellers, okay? These guys are willing to sell into the market when the market comes at those price points. So this is for liquidity. Now let's go over into Bookmap and let me just show you, let me just walk you around this for you to see this, okay? Okay. So this is Bookmap. Let's go to, let's say, this is a much not too noisy. So we have the years here. So when we come over to Bookmap, what we see right now is we are actually seeing the total. We are seeing first, it's very, very confusing if you're a new user. Then we are seeing that we have dots, we have price moving, but let me just get you introduced to that so quick, okay? I know some people know about it, so for those people who don't understand the Bookmap, I think this could be your opportunity. So Bookmap is a platform which mainly looks at the DOM, because look at this, we have the DOM here on the right, we have prices, then we have the bids. These are participants who are willing to come into the market at their own price points, as we are talking about the bid. So this here is the DOM. This is the depth of market. Now that we see here, we have the offers. So all these are the willing participants willing to sell at their own prices. Then we have the current volume profile. This shows us the number of orders currently. This is just according to my settings. Then we have the sessional volume profile. This shows us the volume traded in each session. Now, the plus and minus here shows us when the orders were being added or when the orders were being pulled out of the market. You can just see here the plus and minus. When we see here the total, these are the total orders that have been added and the total orders that have been pulled away from the market, okay? Now, on this area here, which you see coloring here, this is now where we see the liquidity. But this liquidity is drawn historically. All this from here going to the left side, all this is historical. And it is historical because orders can be put in the market and pulled out of the market. So this is the spacer showing us what is happening now and what happened before. We could see an order coming right now, but it could be taken away from the market anytime soon. So let's just go slowly into that. So for example, if we do it like this, it shows us that in every area here, there was buyers and sellers. Now let's try to zoom it. All this information, the numbers is coming into the color. Now, the bigger the order, the more the color goes to the red. So if it's a small order, it's gonna be dark blue. If it's a little bit bigger, it's gonna be a little pale, then goes to yellow, then orange there, then completely red. So when it's a red order, that it means it's a big order. For example, this one here. That is following the information coming from the DOM. So the bigger the order, the more big it will print also, the more aggressive, I don't know how to put it, the more bright, the more darker the color is gonna be, especially coming into these colors, how the color changed to red. So for example, when we are looking at liquidity, we are looking about how transaction occurred and how it was being taken in, how it was in the market and how it was pulled into the market. Okay, for example, look at this area here. We just talked about volume versus liquidity. So we have this level here. This was the level of liquidity. It was in the market for a long time. Then later on, the market comes and trades into that liquidity. As you see there, it got into that liquidity. Then later on, the market started to fall. The dots are the volumes, the red and the green dots. Those are the volumes, the buyers and sellers. But the levels here, these are the liquidity levels in the door. Okay. Another part which you wanted to look into here, just a second here, guys. I wanted us to look at fake versus real liquidity. Now, how can we know that this is fake liquidity and this is real liquidity? Then after that, we look at how can liquidity be effective into our trading and how can we use it to profit from it. Now, if we look into here, we can see that, let's zoom in here. If you see this, we see that there was this high liquidity which was in the market from this time here. But this was very aggressive, and when the market was keeping going, that order was being pulled a little bit from the market. Now look, seconds just before the order was filled, another order was closed. We say an order was closed because this is where the market ended. Now this is a fake liquidity because it closed before price got to it. But the real order or the real liquidity that was still there in the market really stayed in the market. And it wasn't really triggered all of it. You see, we had 119 lots. They triggered some of it, then 119 stayed into the market still. So this one was a fake liquidity in the market, but the real liquidity was present. This one here was the real liquidity. You can just see here, this is 148 lots at the ask. And they got triggered. I think this is like almost 30 lots. 30 lots were bought here, then the market started to retreat to the downside. Okay, so this happens almost like every day. Liquidity gets triggered, then goes against into the market. Now, liquidity gives us the market appetite. What do we expect to happen in the next few minutes? If either the market is going to go up, it's going to go down, based on what instruments or based on the asset class that you're trading. Let's see here on gold. I don't know if you can get this. Now, one thing you'll notice about gold is, one thing you'll notice about Telegram is, about gold is, the market is always in search of liquidity. So look at this. When we scroll down here, I will see another liquidity levels that have been in the book for a much longer period of time. So we see this liquidity has been here, but it has been pulled, been taken back in the market. You can see, but we have an area of high liquidity. Let's forward and see how the market will react to this liquidity. Okay. Look at how slowly the market is following the liquidity level. Why? Because liquidity is like a magnet, is like a fuel to the market. The market is always going to follow where the liquidity is. So let's go on. So we filled. Now let's zoom in here a little bit and look into that. Let's look into what happened. Okay. First we were here in the morning. Then later, look, the market went to further liquidity. Then retreated back, came back down. When the market came down, another liquidity level was put in the same area. And look at how it reacted to follow it. After that, the market retreats. Let's go again. The market follows the liquidity again. Another liquidity level is put there. You see how the market comes from the downside, follows the liquidity. They fill in the liquidity in the market. Let's look at ES. Look at this, the market was down here. When the market was down here, this liquidity was already in the market. The market traded and made sure it came and triggered this liquidity, and it is still going. Now let's scroll here and see if we have any levels. I'm sure the market went to that liquidity level. So let's forward this. Okay, so it looks like my feed is nearly to end there, but we didn't really quite get there. But you get the context when we talk about liquidity. The market is always in search of liquidity, and the market will always find liquidity levels to trigger. So we can just see this as how the market is coming from the downside, going to fill in these liquidity levels. Now, how can we incorporate all these things and put them into one thing for you to be trading? Okay, now let's go into that just slowly. So first, we started with logic. We talked about how to formulate your logic. Then later on, we talked about footprints. Then we talked about volume profile to be as our logic. Then now we talked about liquidity. So for example, we looked at an example where the day closed just above the value area, not too much far. Then we look at a new day which started. We're looking at a new day. That is a terrible drawing. So this is a new day. So when the new day comes, we're expecting the market to rally to go to the upside. So we already saw what in our footprint charts, what we could expect. But what about in terms of liquidity? Now, there's a different number of data feed providers out there. We have CQG, okay? CQG, we have Rhythmic, and we have DXFeed. So I'm using Rhythmic. Now the importance or the advantage of Rhythmic is you are able to see 100 depth in the book. CQG, you're only seeing 10 depth. I've never used DXFeed, but I think I heard it also shows 100 depth, and also you can get historical data. I'm sure on the historical data part, but I'm not sure on the number of depths because I haven't really used it. Now, with that being said, is when you're now looking with the context to liquidity with your setup, it means you will need to go now to your bookmap and scroll on there to see, do we have any high liquidity levels on the upside or on the downside? Why? Because if we have high liquidity levels far away from price, those are the types of real liquidity. Most of the fake liquidity comes in the market on a short notice. So we are looking at this area as potential targets. We could either be seeking to go and fill that liquidity in the market. Why? Because the market is always in search of liquidity. Or we could be heading near to those areas and then where we are going to be resisted in the future. So it could also be as your target, or it could be as your area where you could pick up your entry. So maybe you're seeing here there is 1,000 lots. Then you're saying there is no way that price is going to break this area. Or you're just waiting to see there on your footprint side what is going to happen when price is going to get into this particular level. Okay, so that is what you'll be waiting, or that is what you'll be looking forward to. So this is how you can trade using liquidity, footprints, and the logic, any logic that you formulated. So I'm going to welcome any questions that we have from now. So from my side, I have finished my presentation. So I'm waiting for you guys. If there's any question for you, I'm happy to hear them. So I see here there's some questions. Okay, so when you say stop clusters, what do you mean? Do you mean that, are you saying that how do you find like stop hands or algorithmic movements in the footprints? Well, I'm not sure if that's what you mean, but if you're talking about stop hands within the footprint chart, you'll see that most of the times when they happen, they are only hitting one side. So what do you mean? So for example, this candle here, you see we're seeing there's buyers, but when you see in here, we are seeing there's too many zeros inside. So when they are buying, they're only hitting the offer aggressively. They hit the offer aggressively, take prices to the upside, trap more buyers, then they just go away from the market. So this is a trap move. And the way to notice it, you will see that it is dominated by too many zeros. Like that one, how it is. Do you have any questions from you guys? Is everything understandable from there? Do you have anything that you think is order flow related? Okay, so I think this will conclude it. Not only that, but I wanted to, okay, there's a question here. Okay. Okay, an example. Okay, let's do a new chart here. So the contracts have expired already. Just trying to, just 1 second. Okay, so this is, for example, this one here, this is British pounds, this is British pound, but I'm not really sure about the current data on the footprint side. Let me see. So this looks like, I think the contract has already rolled over here. Yeah, the contract is rolled over. So let's say this will be 6B 0121. Okay, looks like I have to, okay, let's see here. Okay, with this update they want Ninja want us to download the update. So I really need to until I install the update, I can get the new data. But let's try and look on the previous example. This was on, what date was this? Let's see. So this one was on like Thursday, I think. So 00, but what date was it? So this is Friday. Then Thursday. So Thursday is the day in question. Okay. So now, for example, this is Thursday. The market comes from the high. First started with the gap, comes from the high, comes to the low. And look what pattern we get. We get a V-shaped pattern. But not only a V-shaped, we see that there was a rejection there just by looking at the footprint side. If it was coming into the next day, I was really interested to see how this day here, but we don't have the volumes for this particular day. So the market created these levels on the previous day. Now look at how it trades in the next day. It means we open within this range, we try to break above, here we lose interest, then we come back through aggressively. Now look on the retest. What level was retested before? Even this area here. The market after the break retested the level and continued. But we can't really look at what happened there because we don't have the information on the preferred side. So let's look at this one, for example, this specific day here. So we start the day, the market was distributed this way. Now look at it, this is very, very crucial. The day ends, the market was on the lows, goes high, we create a point of control for the day. Then look, we trade away from that. And where do we close the market? We close the market away from the point of control. So coming in the new day, it's already telling you that there is no point for us to go high because the market just closed below the POC. We're expecting to short the market to go down. Now in the new day, what happens? Now let's go to our footprints and see what happened. Okay, when we created the high, what happened when we extended the low and retested that low? Because we have two areas where we could enter here. We either could have entered when price is coming from there or here, or at least now when we are late, we get the retest around these levels and go down. And why am I saying a retest? I'm not looking only at the profile, but I'm looking at the structures which price created. When price came down, this was the first high which was created and it held for a number of times. Then later on, this is where we get a sell to go down. Now on the futures side, on this particular day, so we are talking about this day, it was on Thursday. So this is it. Okay, so let's put this, I'm trying to see this clearly. So we have here the market coming from down. You see, this is where market come from, made that high. So what happened really on this high there? So the market comes down, makes that high. This is the day we are looking for, right? It's not this one. We are looking for this particular day here. So market comes, makes a high, but look what happens before dropping. What really happened on this high here? Now, these are the things which we are assessing. So first, we're seeing there is prolonged buying here to here. Of course, this is during Asian session. Up to all that activity there is during Asian session, up to when London comes in around. London comes in around here. Time 11. This looks a little bit different. Just a second here. So that's not it. That was, I think that was here. It was within this structure. Okay, let's look on the previous, then we'll come on this one here. So that was on the next day. Now on the previous day, this is it. Okay. Okay. So the market makes a high, and this was just during London session. You see the London session here. Market starts opening with going high. Where is it? It's around here. This one here. So this is the London session, London candle open around this area. So this is the candle for London to go high. Now look, just before London's, just on the London session candle, what happens here? Look at how this happened. Look at we have negative delta, but why did the market not go down? Why did the market go up? Because the selling occurred in between the candle. It happened exactly after the market opened. So the market opened, sellers get in, they push prices down, then they fail, then the market reverses and now starts to trade up. Okay. Now, what happened here? Look at this. We have a sequential decline, 25, 2, and 1. This is a sign of exhaustion and absorption. So these guys here, they sold going down. There's no more selling power. Then everything changes. We get buyers. In the next candle, we get more buyers coming into the market. So for you to get into a position, this could be an area for you to get in. Why? First, we just rejected the view up. See, price comes down. We get away from the view up. We're now trading above the view up. We get a rejection exactly on the view up area. Then after that, we are seeing more buying coming in. This is a buyer coming from the lows. And look at how it supports in the next bar and how price continues going up. But here we see that this is an algo push. They push prices. Then they extended this high, which was created here previously. And the market keep pointing on. So your reason to get into the market here is this sequential decline and this absorption, because you're seeing selling imbalances, but they got rejected. The market shifts to the opposite side and starts going to the upside. Now, another area to look at that is when the market came and made a high, why did it turn? Okay, so we made a high the first time, then we extended. Then what made the market exhaust from those highs? Okay, so this one is here. So we made a high, this is the high we accumulated, then we extended, we made a push. Then from there, we now start to go down. Okay, now look at this. Look at this before the market extended there. This was the accumulation area. Price was trying to go up and down, ranging in this area. But every time, this was the only place where we had more aggressive buying. But what happened to these buyers? These buyers are all being absorbed because they failed to continue to go up. They are buying very aggressively, but the market did not respect their follow through. So it was an area where both buyers and sellers are present. Look at these sellers here. This is aggressive selling, even this one here. But the market was just ranging in the same area, and it was a tight range. It stayed here for how many hours? This is from 1300 up to here. This is like 1 hour. The market was just ranging in the same area. It was a very, very tight range. We extended a bit. There was nothing in there. But look at the second time when they now extend this particular area here. This is where they extend. And look what happened. The buyers got absorbed. Okay, we have more aggressive buying. Prices really push to the upside, but we come here, we buy a lot, the market fails completely and starts to drop. We come in the last time, this is the last test. Look at the weakness from the buyers in here. Although the delta was positive, but it's not really positive. This is like a balanced scenario. Because after that, look at what happened. The market just drops drastically. But the setup from the profile will be, what is the profile? Now the setup from the profile here is you are looking from the previous day. The market got rejected from this area here near the previous day's mean. This is where you see that those sellers got absorbed and they failed to continue go down. Then price just start to rally. This is the previous high they extended. But the failure here makes more sense because all the buying power that was in the market, they all got rejected. They were all absorbed and the market just falls to the opposite side. So the so we picked we picked the trade based on how the volumes were transacted on that particular day. We're coming from the lows, of course, then we extend, but we are looking at intraday levels. So when we're looking at intraday levels, we're looking at high of the day and low of the day. What did the market do? How the volumes transacted on the high of the day and low of the day? And so far, we are seeing that on the high of the day and low of the day, on the low of the day, there was more buying, and that was just the opening of London. So in the opening of London, there was a seller who got stuck, and then we just start to see more buyers coming in and pushing prices to the upside. But later on in the afternoon, we see after ranging for quite a while, buyers and sellers agreeing to a price point. Then we got more buyers trying to extend the level, and you can understand why, because price just got a break from the range. This is why we're seeing more buyers. But later they were all just absorbed and price just retreats down. So this happens like every day, most of the times, depending on how aggressive the market is on that particular day. I hope you have seen that setup, or unless you have a different question. Any question from anyone, guys? Feel free. I wonder why most of you are quiet, unless everything I said is just understandable, of course. Okay, guys, I'm really happy to have you today. Uh, really happy to host this. We'll share the recording. We are planning to go 1 hour and 45 minutes, and we are just 2 minutes to the end of our webinar. Uh, we'll meet in the group, chat more. I hope you have the best holidays, and please stay blessed, and bye-bye.